welcome to our interview series where we bring you face to face with the people who manage your money. With these interactions, our attempt is to provide you with a glimpse into these fund managers, investment philosophies, personal beliefs, and much more. Today, joining me and my colleague Chirag is Rajat Chandak, Senior Fund Manager at ICICI Prudential Mutual Fund. Welcome, Rajat.
Hi, good morning. Thank you.
Now, let's begin from the very start. Please tell us what drew you to the world of equity investing right after you completed your MBA.
Wow, interesting question. Actually, a lot of credit for me coming into equity markets, I would give it to my brother-in-law. So he was in the finance world at that point of time. He's pretty elder to me, and I always looked up to him as my mentor because I'd seen his lifestyle, his work, etc., and always kept me interested the finance world. He himself, though, was in the debt markets at that point of time. And he suggested me, I asked him, what should I do for my career if I want to become somebody like you? And he suggested that you should come into the finance world. Obviously, 16, 17 years ago, I mean, actually now almost 20 years ago, that point of time, finance was the key space to be in. And, whatever he guided me, got me into the equity markets. In fact, actually, I did even my summer internship at ICICI Prudential Mutual Fund at that point of time when I was doing my MBA, and that got me even more interested into equities. So that's as straightforward as that. I had my mentor; he guided me into it. I tasted it during my summer internship, and I liked it, and then followed it through.
So how was it, Rajat, after you completed your MBA? Did you get the opportunity to work with ICICI, or were there any other offers? What was it like?
Yeah, so in the college, in the MBA college, I had another offer from another bank. But because what I did during my summer internship, I also got a PPO. We call it pre-placement offers from ICICI Prudential itself. And I was anyways keen on coming into equities, so I gladly accepted that offer. So yeah, that's how it was.
Okay. Rajat, as you mentioned, you joined ICICI Pru directly from the college recruitment. So, and you have risen from the investment from the analyst team to the fund manager. So, what are some of the key moments or the time, over the period of time which has shaped your investment journey?
It's a very interesting world, investing in equity markets, and there would be many key moments, or learnings during this journey of more than 16 years now. But I think one of my biggest takeaways has been that there is no right or wrong way of investments. You would have heard about various styles, which people have. Somebody would follow growth style, somebody would follow value style, contrast style. There are technical guys who follow charts, etc., momentum, so on and so forth. But in my 16 years, I have seen all of those work. All of them work. You just have to play to your own strength. Uh, you know, so that is one of the biggest takeaways. As and when you spend more and more time in the investment world, you realize that there is no one perfect way of generating returns for your investors. So that is one of my biggest learnings, and you start respecting all these styles, different views of people in this world. So that is the biggest takeaway. And second thing is having patience. I think it's a game of patience, investing. More you have the patience to sit tight, sit through your investment ideas. I think it has always paid rich dividends, at least to me. In fact, to most of the people, I'm sure if you would have asked, who have been in this world, the power of compounding, really plays over a long period of time. So you have to have that patience in your investments. So I think these would be my two of the biggest takeaways in the investment world.
Now, Rajat, I would like to move on to a specific fund. You're managing the ICICI Prudential Balanced Advantage Fund with a team of 5 other fund managers. How do you work together and to manage the fund effectively? How's the work divided there?
Yeah, so it is a hybrid fund. It is based on a model in terms of asset allocation. For the benefit, we dynamically manage the asset allocation within the fund. that allocation is changed on a daily basis. Daily, we make changes to the asset allocation, how much equity or how much debt or how much arbitrage, etc., as a position. And that allocation is actually decided by a model. We have an in-house valuation-based model, which suggests us on a daily basis, whether we should have higher equity today or lower equity allocation, for example. And rest is the balance part. So if equity goes down, obviously debt either will go up or arbitrage would go up. So that is the broad way of how the product is, how that is run. So the model suggests us in terms of asset allocation, in terms of equity debt arbitrage, and then within equity, we have my colleague Ihab is also there, Shri is also there, and our CIO Mr. Naren is also there, obviously. We have certain strengths or weaknesses, and we all bring that together in terms of somebody has better understanding of particular sectors, some stocks, some themes, etc. And we based on that discussion, thought processes, we all contribute in terms of sector and stock selection, which is more bottom up. So the asset allocation is more top down based on a model which is based on a valuation parameter. But what stocks to invest in, which sectors to be overweight on or underweight on, that is decided by the three or four of us, and each of us have different strengths. So that is how we work. There is a large part of the fund which stays in arbitrage position, hedged position, etc. There Shri is an expert in the team, and she does take care of that pretty well. So that's how we work. The debt team works separately. We do discuss in terms of allocation, whether somebody needs more cash to invest in at that point of time. So we try to accommodate each other at certain points of time. But then that is a totally separate decision taken by the debt team, where Manish Bantia, our debt CIO, takes the call.
Rajat, but as you mentioned, you are there, Ihab is there, and even Naren sir is there. So could you just explain to our viewers what role do you play? Means there are three equity fund managers. So what role do you play in managing this fund in terms of sectors?
So as I mentioned, right, that I am a little more growth oriented in terms of my investment thought process. So there are certain spaces or sectors which I have tracked for a long period of time, where I have certain strengths and better understanding. It would be good to know your weaknesses as well. So I know in certain spaces I am weak, where actually Ihab or Naren has better handle, some of the spaces and some of the sectors. So it's a very good blend, actually. I tell people, that we get a mix of both kind of investment styles and thought process, be it contra, be it value, be it growth. All kind of investment ideas you could see in our fact sheet in terms of what kind of holdings we have. It is widespread. We would have value stocks, we would have PSUs, we would have high growth stocks, we would have very expensive stocks, and a whole bunch of these. So it's slightly divided in terms of sectoral strengths which people have. So in certain spaces, Ihab or Naren have more strengths, and they would play a larger role in deciding whether to have higher allocation to that particular sector or a particular stock within that sector. And certain spaces where I would have my strengths, and I would bring that onto the table. So that is how we work. Enough freedom to each other in terms of what they want to do. Obviously, we do discuss before taking a large bet or large call, either overweight or underweight on any particular stock or sector. And that also helps. If you have three key guys, so it's easy to vote for or against, for any big call which you want to take. So that makes the job even easier, because if you have only two and you are having opposing views, then you need a referee, right? So that's how it works. Pretty smooth, been for so many years. Never had any issue in the sense of what one wants to do is unable to do that. So that flexibility we have always had in the team, and we respect each other's strengths. We all know who's good at what. So
Rajat, so what is your investment style? What is your investment framework? And what kind of markets, do you like to invest?
see, I am generally a bull at heart. So I generally generally don't look at what phase of markets. Obviously, everybody would want cheaper valuations where risk reward is more favorable at any point of time. So market corrections would be the best times to invest more in equities. So that would be one thing. But I've seen that if you have patience and long time horizon, that is on your side, then I generally don't pay much heed in terms of timing the market. In the sense that when markets correct, then let's have much more, etc., etc. So I think if you have long enough time horizon, returns would be reasonable. It has been reasonable. I would also want to make a disclaimer. People become what they see around themselves for a long period of time. So maybe, it's my bias that in last 16 years we have seen good times in the markets. So you that definitely has an impact on your psychology in thinking, positively, maybe being more optimistic in general, etc. on the market. So that definitely would be there. I'm sure about it. People who would have seen more of bad times would be more conservative, more cautious. So that is one aspect. In terms of my investment style, the two or three things I would want to highlight. One, as I already mentioned, that I have a more growth bent. Now, growth can come from many parts. It could be company gaining market share from unorganized to organized. That shift happening, the company executing better than peers and gaining market share and hence growing at a faster pace than competition. They are entering into adjacencies, which make sense and adding to their potential target market segment, adding new product lines related to their existing business and hence growing at a faster pace. So these are some of the things on the growth aspect. Then, second thing I look at is the leadership or management capabilities, their past execution track record, how they think about running their business, I think is a key part for me. And I'll dwell a little more on that a little later. So how has been the management, their thought process, their past operational performance in terms of execution track record, is the second aspect which I would look at. So, once there is, okay, there can be growth, can be better for this company, for example, then how's the management behaved in the past and how they have been able to execute in terms of the business in last 5, 7, 8 years, maybe. That's the second aspect, which would also mean, in terms of operational performance, how they have done. So I give a lot of importance to past operational performance to companies. Uh, the last one is actually, whether the companies or promoters are thinking about all the stakeholders involved in the business. Ultimately, business have to create value for not only shareholders, but for all the other stakeholders. A very, very strong belief which I have, whether employees are happy, employees are getting value added by working in a particular company, their suppliers are happy, the companies deal with their suppliers, distributors or dealers in a fair and transparent manner, and hence they are also creating value for themselves and customers. In the end, all the companies have customers, they have products or services to offer, whether they are giving reasonably good products at reasonable value, etc. So these are the softer aspects which I try to check a lot more on, you know, doing due diligence, talking to the dealers, distributors, franchisees, suppliers, employees, ex-employees of a particular company in that context. So there's growth, how they have performed in the past in terms of operational performance, and within operational performance, actually, market share gainers are, a big win for me. We have seen in our markets, at least in last 16 years, in any product category, any segment, if a company has been gaining market share, which is consistent and sustainable. Temporarily anybody can gain market share by cutting prices, making losses, or making lower margins. But if that is sustainable, our markets have always rewarded such companies and such businesses very, very handsomely. Seen across sectors, certain companies would trade at a meaningful premium to their peers because they are executing well and getting market share. So that is a big thing which I try to gauge. If they have been able to gain share, whether with their thought process they will be continue to able to gain market share going ahead as well, and that is a key thing. If I delve a little more on, market share gainers, see, we always talk about the moat of a company. What is the strength, key strength? I very strongly believe that management, culture, DNA, character of a company, is very, very important. And that's one thing which is actually very difficult to replicate by competition. So if a company is able to gain market share, having a certain DNA, that itself can be a moat for a company. People can ask about, whether they have technology, whether their distribution network is as large as their competition, etc., etc. Those are partly measurable, maybe, but these things, the softer aspects, is what I try to gauge. The culture, DNA, that the competition cannot copy. That is very, very difficult in big companies, big businesses, to change the culture of the way they work or think. So that gets reflected in, if the company is gaining market share.
Yeah. Rajat, I'll just come to, you mentioned you're a bull at heart.
Yeah.
And value research, sorry, not value, sorry, ICICI Pru is known to be a value focused fund house. And also Naren sir is a hardcore value guy. So how do you manage between this finer aspects between the growth and value?
It is not that difficult, actually. I don't know why people have that perception that ICICI Prudential is value house, and how I try to manage internally, let's say, how this balance is created when, most of the people may be value oriented, maybe within the team. I think, what, spending long time in a company with same set of colleagues, gives you that leeway, gives you that cushion, actually, because other colleagues and, Naren have seen me for so many years, and they know that that is my style and has been my strength, which has helped me work for the company as well. And then you keep getting that leeway. So now you have mutual respect. Initially it would have been when I was much younger, 16 years ago. I was just a college pass out, right? It takes time for you to build that rapport, that reputation, that, okay, this is my thought process. It has worked for 5, 7, 8 years now. And then slowly people realize, okay, that is his strength. It works. So let him be. So there is enough freedom in the company for everyone, not only me, to pursue their own style, or thought process of investment. So I think now, with a lot of people, seniors, at least at senior level, we have people for working for 8 years, 10 years, 12 years in the team. So you get to know each other so well, and that gives that comfort.
All right, now moving on to your opinion on, what characteristics should a stock have to be considered a good investment?
Wow, there's a mix of it. I already spoke quite a lot. So when I said that there is no right or wrong investing style, is
Right.
is is part of that. It can be value, it can be growth, it can be momentum, so on and so forth. Quality, high ROEs, high cash flows, various things do work. But for me, as I mentioned, the two most important things is, the growth outlook, the longevity of growth, and second is how's the management performance has been, and whether to get that comfort on they will be able to continue to execute even in the future, um, better than peers, better than competition, in a more sustainable way. I think it's a very bottom up thing. It depends from company to company. So that is the other thought process which I have. I try to be a lot more bottom up, evaluating companies and selecting investment ideas. I think that makes a lot of difference, because even in a, so-called great sector, which is doing phenomenally well, you will always have some companies which would have underperformed meaningfully. So what matters is how one company is executing versus the competition,
Mhm.
and that I think you can gauge only by doing more bottom-up work. One can take a top-down call on a sector, but within that sector also, you will have differences in relative performances of the companies within that sector. So I think that is it. I think, be more bottom up, growth orientation, and management quality. And the last one also is having patience. I would have many investment ideas, where I have held investments for 7, 8, 10 years even, for a few names, which I've been holding in my published portfolios for a long period of time. So just find the right company and management and just stay put.
Rajat, just wanted to understand your parameters. If you know if everything is as you discussed, everything the stock falls in place, the management, the quality, the growth, then how does that particular stock enter your portfolio? What is the procedure for that?
So we have a pretty large team of research analysts, tracking various sectors. They give a lot of inputs. As I mentioned, that I try to, you know, tell them or try to figure out from them, by doing more bottom-up research. Uh, is more qualitative, honestly, because numbers everybody can see, right? Everybody can see what an ROE of a company is, what the debt equity is, what kind of growth they would have done in last 5 years, 10 years. That data is same for everybody. So what are the other things which I can add in evaluating a particular investment idea, which then will make the cut into the portfolio? Are these softer aspects actually, and that is why people call, it's not only science investing, it's a science and art, it's a mix of both. So data is with everybody has those top down numbers, what kind of GDP growth will be there, what kind of multiplier growth will be there in a particular sector, so how that sector will grow, how will be the profitability, whether the competition is fierce or not so fierce. But you have to gauge, with which management, even if there are setbacks, which management could help their companies bounce back much faster or a better way than their competition. Or if there's opportunity which is becoming larger or larger in a particular sector, which management could garner higher share in that opportunity. So it's a lot of bottom up work, I think. Obviously, it is. I would not say that 100% of my portfolio would be all bottom up. As I said, all kind of styles work. It has to be a mix of 2 or 3 styles which suits you. Somewhere top down may work. A lot of places you need bottom up. So it's a mix of both portfolio. But my idea typically is that at least 40-50% of my portfolio, or my holdings, are the ones where I'm, totally on top of, on a bottom up basis, what the company is doing, how is it, the business is moving, etc. And rest is obviously we have a large team, you depend on them. You have experienced colleagues, their views, where they have their strengths. So, we can't be experts on everything. I tell people openly, you can't be an expert on pharma also, and in oil and gas, and in commodities, what is happening in China. Can't track so many things. So you depend on the team for certain things, certain strengths you have. You try to play to your strengths. So yeah. So coming back to how I decide. So one is obviously, numbers is in front of everybody. There has to be some basic hygiene factors and numbers. Debt cannot be too much high, or ROEs, ROC should be at a particular level. Should be at least at average levels, for example. So these are, numbers, just numbers. But beyond that is, what kind of growth opportunity is there, uh, which requires some kind of imagination. Actually, it is not that easy. Some imagination is needed to see, how this sector can grow, how this company can grow, what all they can do, what all they're thinking, and then just whether management is right or not. And then I think in my investment style and thought process, my process, valuations actually come towards the fag end of my filters. At last, I may still say, ki, okay, it's too expensive now, maybe, and I'll wait for a better price. But it will still be probably a fourth, fifth, or sixth criteria rather than the starting point. That I can tell you.
Coming to the ICICI Pru Balanced Advantage Fund, it has seen some challenges recently in terms of performance. Rajat, could you explain us what are the reason for this? What has impacted the performance, and how do you plan to improve the performance going forward?
So as I told earlier in the interview that, it's the asset allocation, it's a dynamically managed fund in terms of asset allocation. So you'll have equity, you'll have debt, you'll have some arbitrage positions. What levels of equities we have to keep in the fund at any point of time is suggested by the internal model which we have. Okay. So, and that model is based on a few criteria, but major one being valuations. Okay. So as and when valuations of the markets at an aggregate level would move higher, the model would suggest us to reduce the equity allocation because it's becoming a little riskier. Valuations are expensive, it is not attractive as an asset class. And so you keep reducing your equity level. If you look at markets in the last 2 to 3 years, especially post COVID, markets have continue to go up. They've kept on delivering handsome returns. What that meant was whatever valuations were there at markets 2 3 years ago, today they are higher and higher versus what they were. And not taking away the fact that earnings growth has been pretty strong in last 2 to 3 years. So earnings growth has also been good, but still, even after factoring that in, valuations have become richer at an aggregate level. So the asset allocation, which we have is towards the lower end, has been towards the lower end in the last 12 to 15 months, maybe even 18 months. So the fund has, a range of 30 to 80% of equity, net equity levels, which we can have. On an average, in my top of the mind number, it would be closer to 40% in last 12 to 15 months. Okay. So it has been towards the lower side of the allocation. We have seen this a few times in last 7 to 10 years. Whenever the market is unidirectional, going only in one direction, we have always faced this challenge in this particular product. And it's a very simple reason. We kept cutting equity allocation and markets kept going well, so our returns suffer. But the company, thankfully, because we have seen so many cycles, appreciates that we have to see performance over a market cycle. You can't see at market towards the higher end or towards the lower end of valuation, because at that point of time performance may not look good. So we look at midpoint of markets where we think at that point of time our performance should be reasonable, is how we believe. So there's a lot of comfort. Initially, when I started managing this fund maybe 9 years ago, I became the co-FM. Couple of times we had these challenges to explain internally also. Not the right time to see performance at this point of time. Markets have been unidirectional. I would not want to use any other word. It's been unidirectional. 2017-18 was one phase. Even a couple of years ago, we had different challenges when markets went up, etc. So after seeing that, when markets sober down a little, also, the performance improves meaningfully. Historically, at least, that has happened. So a lot of senior management in the company has that buy-in now, in the sense that it's okay at this point of time. It's okay if our performance is not good. We will look at only over a market cycle how the performance is. So that is one thing. Second is in terms of what we can do to improve performance. As I said, asset allocation is decided by the model. Not that we are sleeping over the model, in the sense if there have been enough number of times when this question would have come in last 10 years that whether the model needs some tweaking. Is your model too conservative? In rising markets, it doesn't do that well. But we continue to look at adding factors, adding various metrics, whether it would have helped the performance. And we backtest it for 20 years. Had we added this factor, whether the model would have given a different result, a meaningfully different result. We keep doing that, keep evaluating that, but we haven't found anything meaningful so far, that we need to change the model. And that brainstorming happens between me, Ihab, Naren, Aditya, Manish Bantia, etc. Even Anish Tawakoli. So get together, sit whether it makes sense to add any factors fundamentally, logically. If a lot of us agree, then we look at the data, we backtest, had this factor been added or not been there, whether it would have helped the performance of the model meaningfully. If we find it is meaningful, then we would add it. If we didn't find, it wouldn't have helped much, we would leave it. So model has worked for 15, 17 years now, I think. So over time, over a long period of time. So that is how the performance has been. What we do, we keep evaluating these things on a sector and stock specific levels. We have a performance measurement and attribution system which tells us, which we can see, whether stock calls have gone wrong or whether sector calls have gone wrong. And whatever I have seen last the data and its published portfolio, we can see a lot of the bets which would have taken have actually worked. So I think it's a slight that phase of the market where asset allocation is hurting a little, but we are not too bothered about it.
Okay, moving on to your Flexi Cap fund. The portfolio there favors the consumer discretionary sector heavily. I think it's around 34% as opposed to the category average of somewhere around 13%. What's driving your optimism here?
It's very simple, right? Simple economics, as and when the per capita GDP growth will keep improving for our country. We are today the fastest growing large economy in the world. The discretionary products have much lower penetration levels in the country. Okay, that penetration will keep going up, be it air conditioners, be it four-wheelers, cars, SUVs, for that matter, even footwear. eh, You know. So there is huge scope for penetration to go up in the country for discretionary products, be it consumer durables. Just a number, probably the penetration which we have for cars in India is 1/20th of what we see in the developed worlds, be it US, Japan, European nations. So there's huge scope of penetration to go up in many of such categories. This is just one example. The other thing is again mathematical, that if in if the average income goes up by 25-30% over 3 years per capita, the people at the upper middle bracket of income curve, or even high income curve, that will not go up by 20-30%. That will go in multiples of that. Okay, it's a simple statistical curve where the curve itself shifts a little over a 3-year period, for example, and number of people who are earning more will go up in multiples. So that will drive consumption in the discretionary space in my view. And it's a story of decade in my personal opinion. So many products, categories, services in discretionary side, which can see pretty strong growth over next 5, 8, 10 years or even more. So I think I'm a very strong believer in that, and hence I'm meaningfully overweight in that segment, and it's across. I mean, the different products, different services within discretionary, you can play through, and so it's reasonably well diversified in that context.
Now coming to the high P stocks, and we found some of the high P stocks in the portfolio. So what's your view on holding this high P stocks? And just wanted to understand again, how do you convince your CIO, or how do you tell him to invest in, though it's your fund, but how do you tell him that I want to invest in this stock? And what's the viewpoint between you both while investing in this high PE stocks?
No, as I said earlier, there are many things which goes into building portfolio in my thought process. First thing first, because I've spent so much time, again, just for the sake of reiteration, spent so much time, me seeing Naren seeing me, for example. We know each other's styles, we understand it completely, each other's strengths, and now Naren has given enough freedom, for anybody to do whatever they want, as long as it is not outright irrational in his view. Okay, it cannot be outright irrational. So that he would definitely question and delve much more onto why this seems absolutely out of whack, for example. Coming to high valuations, stocks in my portfolio specifically, I already told that also. My filter valuations are probably fifth or sixth criteria which I would look at. So what I look at is again growth, potential target, market, whether that can be large growing market, whether company has been gaining share, how have they performed in the past, execution track record. If that is there, and if you have time horizon, I think one of the key differences I can tell you is, I think the time horizon which one investor has versus the other. Internally we have so many times we have debates with even the analyst. That analyst is negative, for example, and I am positive on a particular stock, or vice versa. I'll tell you 99% of the times the reason is only time horizon. Analyst is thinking maybe in next 6 to 12 months there is nothing gonna happen, things look negative, demand is weak, or competition is high, etc., etc. And I would think, okay, over a 5-year period, whether this space would still again revive, whether the management is strong, etc. I would like to bet on that company. So I think 99% of the time it is only about the difference in time horizon with anybody. If you elongate your time horizon, then there is no problem. There have been enough arguments vice versa also, within some discretionary space. The sector is going through upcycle, for example, and a lot of my colleagues were bullish on XYZ names, and I am negative, saying, okay, again, the reference is time horizon. I'm saying structurally, weaker franchisee over 5-7 years, they'll continue to lose market share. Okay, but a lot of my colleagues who actually went right saying, boss, but at this point of time, demand is looking up. You are in an upcycle in the sector. Rising tide will lift all boats, so we are okay. So again, there also, in short run, maybe I have gone wrong, but in long run, probably it'll work in how I thought. So I think it's only about time horizon, which can solve most of the differences.
I would like to know a little more about your outlook on new and emerging companies in India. What criteria do you consider when assessing their investment potential?
Yes, two of the biggest questions which are very, very difficult to answer for some of these companies is potential TAM. And what is the target market? How big is their market, which can be, it's a new segment, started a few years ago, but there is a trend. How big can that potential market can be, the industry size? I think definitely you need some imagination in that, because there's no math, there is no precedent in the sense that, let's say it's a globally new business segment which has emerged, for example, in the last 5, 7, 8 years. You don't have history of 20 years, 30 years, what happened in the Western world, or let's say, for example, in China, for example, and maybe that could play out in India. A lot of things you keep that in mind, how it played out in other elsewhere, and whether that could also play out in India, and base your investment thesis. But some of these new age names and companies, they are new globally. They are new globally. They have very short history. So then definitely you need more imagination, slightly more imagination, whether it makes sense. Try to gauge whether they are adding value. Again, the same thing it comes to, whether they're people who are working for them, they are getting, their value gets added in terms of either good pays, good working conditions, etc. They are happy working there. Customer is wanting something. Is there a need? Sometimes even customer doesn't know that there is a need of XYZ thing. So sometimes that is also, customer also doesn't know till you show them, this was needed for you. So whether they are satisfying a particular customer set, which had that need, other channel partners, whether they are happy, whatever money they are making with the help of these companies, etc. I think these are the two key things which you would have to understand. And in doing a lot of these things, the companies have to be just efficient enough to make decent ROE. I think that is the other key, obviously, right? Anybody can keep growing without making profits. And very easy. Put a sale 30% discount and you will have great sales, but no profits. So try to gauge whether that math could work, how it could work for them to become profitable, more profitable. Is it sustainable, possible? So I think, yeah, definitely some imagination is needed. um, uh, and being a bull at heart and optimist, that doesn't become a challenge for me per se as an individual. But you keep doing more and more work, keep talking to people, talking to competition, talking to ex-employees, try to gauge how they're working, what are they thinking generally, and try to make a sense out of it. So, and as and when if they deliver what you thought is possible, then you probably increase your investment positions, saying that thesis is playing out as I thought, and will continue for another 5 years or 7 years. So stay put. There will be volatility, there will be challenges in between, but I think that's part and parcel of any investment idea in the portfolio. It's not only true for expensive or loss-making companies. Even for value names, if businesses go through their own bad times, that stock also goes through its bad times. So it's not only attached to very expensive, new age or loss-making companies. It's attached to every company which doesn't deliver or goes through a bad phase. So yeah, so I think that's it.
Rajat, finally, before wrapping up this chat, in the current market scenario, which are the sectors where are you finding opportunities in the market?
I think a lot of thing is on a bottom-up basis. I think, at least in my portfolio, my thought process, I generally don't believe in, you know, making blanket statement that, it's in bubble territory or extremely expensive kind of things. India is a very large market. You have probably more than 5,000 companies listed. uh, you know, More than 500 companies, at least we cover internally in-house as a team. In those 500 companies, whether you can find 10 or 15 names, where you can have a reasonable investment bet size, I think should not be a challenge. So, 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 so yeah, I think it's difficult for me to put various sectors. I can't even speak about most of them, but certain sectors are going through a down cycle. Post-COVID, some sectors benefited massively because of this China plus one thing, and unable to supply materials. So those sectors went through the roof, but then it all went through a down cycle, and enough names, sectors which are in down cycle at this point of time as we speak. And what you need is only patience, and some point of time the cycle will come back for them. So that is there, but most of the names for me actually are more on a bottom up basis. I think that is how I would like to look at it, uh, for my portfolio. But I can be rest assured there are enough names in even that universe of 500 stocks which we cover, that you can have a reasonably balanced portfolio, which can do well in the mid to long term.
Well, thank you, Rajat, for taking the time for this interaction. Time for us to wrap up this chat now. We hope our viewers benefit from the insights that you've shared. Thanks.
Thank you so much.